Hello, everyone. Today on the final bar, we are wrapping the week. This is our normal Friday routine where we like to wrap up the week's market activity, try to make sense of things in terms of the short-term movements of the last 5 days, how that fits into the big picture, into the longer-term trends. This week was about oil disruption. It was about stocks continuing to grind higher, with Friday being maybe a perfect way of wrapping up this week. So we'll take a look at all those asset classes, get us ready for the weekend into next week. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller, the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the price action of the day and try to make sense of these markets that seem to defy sense. I feel like every time you feel like you just have a handle on what's happening, things continue to evolve. But overall, I think Friday is a really good opportunity to take a step back. The weekend for me has always been a really good time of trying to digest what's happened when the market's sort of off hours and try to pay more attention to the long-term trends, how they've evolved. So a lot of movements this week, and we've had some really good guests this week, honestly, helping us try to understand the dynamics. If I think about my guests this week, they were all relatively negative on stocks, and I think that's the frustration for me and many other strategists right now. Plenty of negative signals, plenty of weakening breadth signals, plenty of indications that this is about where we should turn. We haven't done it yet. So we'll try to make sense of that. You're looking at a lot of different charts today. I did want to move on, though, and remind you some of the great guests and specials we have coming up next week on StockCharts TV. So on Monday on Behind the Charts, which is our interview-style show, we sat down with Todd Gordon, one of the recent Traders Expos, had a great discussion about how he thinks of charting. He's very short-term oriented, thinking of trading, about performance, and some really good lessons about how to manage your game, both with the charts and also mentally. On Tuesday on the final bar, we have Craig Johnson from Piper Sandler. On Wednesday the 29th, Todd Sohn from Strategas in New York, and then Greg Gunther from Agora Financial will join us on Thursday, April 30th. He's from Baltimore. Some really good guests there. And then just so you jot it down, our next episode of The Pitch, this is our new monthly show where we have one host, 3 guests, 5 ideas from each of them, and then a really good discussion about what we're all seeing as a group. Next one's coming up on May 13th, hosted by StockCharts' own Grayson Rose. So it should be a really good discussion of some ideas for the markets. Let's get into a market recap. So as I've alluded to, if you're along with me expecting some sort of disruption to this bear market rally every day like yesterday, that feels like we finally turned the corner and we're going to start distributing a little further. A day like today comes in and just takes us right back. So we're going to look at the last week in a little bit. I just want to highlight equity returns today to wrap up Friday's session. So the S&P really was sideways through much of the first half of the day, really up through lunch, and then just sort of stepped on the accelerator and went further and further to the upside, finishing up about 1 1/3% to close around 28.37. Mid caps and small caps up as well. Mid caps about the same as large caps. Small caps up a little less, about 1.1%. The Nasdaq 100 leading the way with technology, our number one sector. So not surprising to see the Nasdaq 100 back up 1 2/3%. The VIX now below 40, so it's down to 36. And again, the VIX, while still relatively elevated, has continued to go lower and lower. And as the bear market rally has continued further and further up, volatility coming down as we seem to be reaching the stability within the uptrend. If you look at the last 5 days, though, I just want to look at that, and then we'll look at the daily chart. If you look, the last week, we really didn't go anywhere, and it sort of has felt like that, while, and I think, to be honest with you, I think this is maybe how it sort of validates that we're near the end of this bear market rally, is you have sort of indecision. Over 5 sessions, we started and ended right about the same place if you look at the SPYs. Tuesday was where it really felt like we were going to start to roll over. We gapped down and it felt like, okay, this is the beginning of that next leg lower. didn't happen. And so the confirmation we've talked about before, you get a down move, you want a validation, or you get a breakout, you want a validation with a further close in that direction. We didn't get it. And so I think even yesterday, sort of we traded down toward the lows. We closed about near the lows of the day. Today we opened and continue to bounce off that same level, which is around 279 on the SPY. But then we've gone away from that. So what's happened in the last couple of days, we've sort of set this range, and I think that's what's going to be important going into next week to see if the spider is able to hold this 279 level. Clearly, that's become very important. If you look at this chart, look at the hourly chart, you'll see that the level of support that's becoming more and more clear. And now we have the upper end. Yesterday's high is about where we peaked out today, just under 284. And I think one way or the other, we have to break one way or the other going into next week. And I think that's potentially going to indicate sort of the next move from here. The daily chart continues to look pretty similar. And again, while we moved a lot during the week, in the end, we really didn't move anywhere directionally. It was more of a choppy digestion sort of week. And now we've really set into this range, if you look at the daily charts, between 2720, 2730, and maybe 2870, 2880 on the S&P. So we're looking at the S&P cash now. And if you look, a while ago when we really started rallying out of the lows, I started putting these shaded areas on the chart, sort of identifying some of the previous support and resistance levels and assuming that those might provide some color. And now they've become sort of the range, right? This is where we've been the last 2 weeks, really. So now all of a sudden the market's starting to look like a huge move out of the lows coming off of that bullish divergence with the RSI. We've now come into a stable range between 2720 and 2880. And now the question is, what's next? And do we break above that upper end? Do we start to accelerate through 2950? Or do we break down? We break below support in 2700, I think would be the trigger indicating that, with 2650 being the last Fibonacci level. And so, again, the most frustrating direction the market can go is not up, it's not down, it's sideways, because it feels like no one's satisfied when the market's just sideways. I think that's what we're seeing right now. Let's look at the market recap, see what else. What other themes we can uncover. So tech, we've talked about the challenges of technology. Tech's been such a great leadership sector for the last 16 plus months, probably really after the market low in 2018. It's done very, very well in the uptrend last year, also in the downtrend this year. In the last 4 to 6 weeks, it's sort of struggled on a relative basis. The relative strength has been sloping downward, sort of indicating it's less leadership. But today, back on the upside with the XLK, the number one sector, up over 2%, followed by consumer discretionary. We're going to look at that ratio, consumer discretionary versus consumer staples, in our next segment. You'll see how that's actually starting to potentially resolve to the upside. After that, you have materials, you have financials, you have healthcare. On the bottom, we have energy. It's sort of flat for the day, but the worst performer out of the 11 S&P sectors, followed by real estate and utility. So in previous days when we've seen this rally, my qualifier to that, my qualifying comment has been, but there hasn't been sort of the traditional leadership at the top and the traditional, defensive groups at the bottom. That's sort of what I'm seeing today here. I'm seeing tech, consumer discretionary toward the top. I'm seeing financials outperform. That's all pretty good. On the bottom side, I'm seeing energy as an underperformer, which does not surprise me. But I'm also seeing utilities and real estate. So it's really more of a normalizing of what we've seen recently. We don't have time, unfortunately, to go through a lot of the individual charts on here, but I would point out things like FCX. This is Freeport-McMoRan, which within the materials sector. Twitter, a name we're probably very familiar with. You can see some of these charts are setting up really, really well. So while the market has felt like it's in a holding pattern, you're starting to see signs that some of these names are actually threatening to break above the upper end of that. So if you look at resistance around 870, let's say, which was the high from a week ago, you can see that Freeport-McMoRan actually testing the upper end of that, testing the 50-day moving average from below. So again, charts like this, two things can happen. One is you get the follow through next week, you get the upside movement, or we continue to chop around, we test more the lower end of the range. So I think going into next week, and I'm excited for the, going through the S&P charts this weekend to see what sort of themes we can tease out. That is our market recap for today. And again, it was more of an offensive move. I'm surprised to see that, only because I'm expecting, more of, I would assume more of a retest of a lows more than I would expect the S&P to be in rally mode. But we continue to move higher. Let's go into our next segment, which is Wrap the Week. This is where we take a step back on a Friday and try to make sense of how this week fits into the big picture. I did want to start with a survey that we did recently. And as a reminder, we always have a survey running on the StockCharts TV channel on our website. So to the right of the video, you can always answer the open poll, and I'd encourage you to do it. It's a great way to continue a dialogue between you guys, the viewers, and me running the show, and other hosts as well, which will refer to those polls. Also on our YouTube channel, we have polls going as well. So if you subscribe to our YouTube channel, you'll get some poll notifications as well. We asked you, will crude oil trade above $30 again this year? It's so funny. We asked this exact question a couple months ago, and I think I asked it as $60. And so I don't think we could do that anymore just because the world's changed so much. But this is the chart we're referring to. This is the $ WTIC. It updates every day for us, and it's the crude oil continuous contract. It's one of the futures that we track on here. And so right now it is around 1650. We'll see on Friday's close where that ends up. But basically, will it trade above $30 a barrel, which would basically put it above the peak from April at this point? The answer was almost split. 56% of you saying yes, you could expect it to go above $30. Only 44% of you said no. So actually a little more even. Last time we had a bit of a distribution. This time it's sort of a 50-50 guess, a little more on the positive side that we'll reclaim that. Again, that seemed ridiculous when we're down here in single digits, but you know, it only, with how the volatile that oil is trading now, it only takes a couple of days for that to seem much more accessible. So, and the reason why I phrase it that way is important. I think you could see crude oil recover for sure. I think there are a lot of people, a lot of firms, a lot of investors that are interested in getting back at least into the range where it was March to April, if not much higher than that. And obviously, a lot of companies are gearing more towards that sort of range in the $50-$60 a barrel range, and we're well below that. But we have to get through that first congestion first. I think when oil does get back to that level, that's going to be really the line in the sand, $30 a barrel, depending on how things roll over. Continuing in our efforts to wrap the week, what I like to do is use the Mindful Investor Live chart list, which is, where did I put that? Here it is. Nope. Give me a second here. I got lost in my own charts. Here we go. So this is looking at the Mindful Investor Live chart list. Again, if you've not accessed this before, this is open to everyone. Just click on the articles page, go to my homepage on StockCharts, which is called the Mindful Investor. You'll see a link to the live chart list on the top. You can get right to this list of charts. But this sort of goes through how I walk through the universe on a weekly basis, and I refer to this during the week often as well. What I'm starting with is the weekly market trend, and this is a chart that I've used for a while now. And it essentially, you know, for me, the market is in 3 time frames. The long term is multiple years. The medium term is a couple months to a couple years. And then the short term is a couple days to a couple weeks. And I really don't pay as much attention below that. It's not where I'm trying to anticipate turns. It's information, but it's less the trend that I'm trying to operate on. So this chart sort of encapsulates what those 3 time frames are looking at right now. So on the top, we have the 21 and 34 week exponential moving averages. And then this is the PPO showing you the difference between those two. And if this is above 0, that long-term trend is positive. If it's below 0, the trend is negative. So it turned negative mid-March, has remained negative again. And that's one of the reasons why it feels like a bear market rally. It feels like the weight of the evidence still lower based on the severity of the sell-off that we had February into March. The bottom, we have a weekly PPO, similar to a weekly MACD using the traditional settings, 12, 26, and 9. And so the lines here, the green and the red lines, are the weekly PPO, and whether or not that's been a sell signal where it crosses down through the signal line or a buy signal where it crosses up, that defines for me the medium-term trend. So this turned negative mid-February before the long-term trend, and has remained in a negative pattern. That short-term time frame for me, I use the difference between those two bars, and that's the histogram here in the middle. So that turned negative beginning of April and has remained positive. I'm sorry, turned positive beginning of April and has remained positive over the last couple weeks. And that's where you sort of measure this bear market rally. And that's why I keep saying bear market rally and over, because that's the chart that I would use to sort of quantify those 3 things. So it remains in that phase. You know, looking at the daily chart of the S&P, again, I think we're sort of in this range now between resistance and support. And these are actually drawn from support levels going back over the last year and a half, really from the 2018 market low, which was down here. We had that rally to the market peak in February, even though a number of sectors peaked out in January. And now we're sort of settled in that range, right, between 2720 and 2870 or so. And again, I think I'm looking for which way we break out of that range. It's been range bound for the last couple of weeks. The RSI is almost dead even at 50. It's a little above the neutral level, but essentially telling you there's an absence of trend at this point. We had the rally and now we're just chopping around, and it's unclear whether buyers or sellers, I think, are going to take control from here. Now, the breadth picture overall has remained positive, but not, depending on which chart you look at. I think this is one chart that sort of confirms the bull market sentiment in the short term, which is the cumulative advanced decline line. So it's advanced decliners for the S&P, for the NYSE, for mid caps, and for small caps. And all four of these I've color coded green just because they've shown higher highs and higher lows on that time frame. So as long as that continues, that pattern continues of higher highs and higher lows, I think you have to assume that that this bear market rally is continuing. And the signal that this is reversed is if you get a lower low and or a lower high, some combination of those two, and we haven't seen it yet. So on this, where we're at right now, do we establish some sort of lower high? That would be the next potential signal I'd be looking for. Now, we've seen an absence of new highs and new lows, very few on either side, and that tells you sort of this absence of leadership. There are very few stocks pushing to new 52-week highs. There are some, but very few. It's pretty rare, and most stocks are sort of within this range. And because the range has been so wide, I think these lines are going to remain muted for a little while until you either get a buildup of momentum, you get broader buying across the equity space, which would push more and more stocks to 52-week highs, or again, the bear market rally exhausts and you go lower. But again, I don't see that being a huge change in the near future. This is looking at the percent of stocks above their 50-day or above their 200-day. And we're a bit in uncharted territory. We don't have much of a historical analog, I think, to compare this to. But it is worth noting that about a third of S&P names are back above their 50-day. That's up from 0 just a couple weeks ago. So it shows you the severity of the move. Just a couple more quick charts, and then we do need to take a quick break and continue on with our mailbag segment. One really important chart to pay attention to is the AAII rankings. This is the American Association of Individual Investors. This is their bullish or bearish or neutral rating, and it's worth noting because we've had a huge change. The last couple weeks, it's become closer and closer to 0 with even bulls and bears, and the number of bulls has remained relatively steady in the upper 30%. That has jumped down significantly this week. So down to 25% bulls, down to 50% bears, which puts it more at the level it was on the initial sell-off in March. So it certainly seems like individual investors, in terms of what they're saying, in terms of how they're voting with their voices, are saying they're turning more bearish here at the expecting an exhaustion in the bear market rally. The question now is, do investors vote with their feet and push prices lower? Last chart, I promise, and then we're going to move on, is the ratio of consumer discretionary versus staples. We've talked about how this has been relatively stable. It's just threatening to break above here. And if you draw a trend line on the peaks from March and April, we've now broken above trend line resistance. This is an equal weighted measure of consumer discretionary versus consumer staples, suggesting to me that we're starting to get more of a push on the offensive side. People are going on the offensive side of consumer, which is actually very different than what we've seen for the last 4 weeks or so. We're going to take a quick commercial break. Be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. I want to move right on into our mailbag segment. Really appreciate all the questions you guys continue to send in. Very, very thoughtful, and sending visual aids along with your questions. Excuse me, I really, really appreciate it. Question one came to us via Twitter, and our Twitter handle's @FinalBarSCTV. Tag us anytime and we'll take a look at it. For the mailbag, if you were lucky enough to buy a coronavirus stock, example Zoom, Teladoc, or Regeneron, can you comment how to handle the trade with a big profit in a bear market? You know, that's a really, really good question. And I'll go here to my chart, bring up Zoom as a good example. We had that segment or that first session of the pitch about a month ago. And I had Tom Boley, Mary Ellen McGonigal, and Grayson Rose on, and I was moderating that discussion. It was a really good discussion of sort of coronavirus plays. This is still, I think, where everyone's still trying to get their head around things about a month ago. I feel like we've grown a lot in terms of our awareness of how things are going and our expectations as well. But there were a lot of stocks like Zoom. It was what sort of names would kind of do well. So your question was, let's say you had perfect foresight and bought into this maybe at the end of last year. And this whole event and how these things have played out have caused you to be in a really good place on a stock like Zoom. It's just been fantastic. Now what? So obviously my answer is sell it yesterday, because that would have gotten you out of this huge distribution day today. I'm totally joking there. You know, what do you do with that? So, you know, in this sort of move in a bear market rally, I think if you are long, or if you are in a position where you're owning things and what you don't want to do is give it all back if and when the market goes down in a big way. And I totally get it. So in my way, the way I tend to think of it is to switch more into trend following mode. Let's say you bought the bottom, right, in October or in December. Beautiful, perfect foresight. You knew it was coming and you were there. You know, in terms of how you handle it now, at some point along the way, you have to be thinking more like a trend follower and lock in some process to, you know, or develop some process to lock in gains and anticipate, you know, and just prevent you from giving it all the way back if the stock round trips down to 65 or something, right? So there are a number of ways to do it. And trend following, you know, moving averages are one of the more common ways to do it. What strikes me with Zoom is that the 50-day moving average has been relatively consistent. As long as it remains above an ascending 50-day moving average, I probably feel pretty good about the stock. The problem, though, is that's a really far way away from where we're at right now, because it's done so well. So there are other indicators that are a little more dynamic, if you will. If you go to the overlay section, there's one called the chandelier exits. And this is something that the name of the man who created these escapes me, and I'm so sorry, whoever you are, but I know that Dr. Alexander Elder, who's contributed a lot of content to us over the years, speaks about them in his books, if you've read some of his books. And it's basically an indicator based off of the average true range. And so something like that, parabolic systems comes to mind, things that are going to be a dynamic trailing stop to, you know, to keep with you as long as you continue to gain, but give you some sort of signal when, you know, even if you don't follow it as a system, something that will remind you to say, hey, revisit Zoom. Do I still want to own that position? Do I want to take 50% off? What is it? So for me, to be honest, and thanks for the question, I would think more like a trend follower. Use something like the chandelier exits as a way of being more of a dynamic trailing stop. This one based on average true range. So I know a lot of people find it pretty helpful. Question number 2, what does this index measure? And you actually sent a chart. I did not use your chart. I kind of created my own, but it was this ticker right here, which is !BINYHLRSI. And sorry, when we get to breadth indicators, we have to add a lot of letters just to categorize all of them. So this is actually one you probably are not familiar with, and that's totally okay. If you go onto the description for the index, and then I'll show you how you can get to this page in the future, basically says it looks at the 52-week highs, the new 52-week highs on the New York Stock Exchange, and the new 52-week lows, and it's the 14-day RSI on the 52-week lows subtracted from the 14-day RSI value on the 52-week high. So it's sort of like an RSI on the new highs and RSI on the new lows, and taking the difference between the two. This is kind of a zero right now, essentially because there are very few of either. There are very few 52-week highs, very few 52-week lows. So the name might be a bit confusing. That's what it's representing. If you're ever unclear as to what a breadth indicator is, what you can do is click on the little magnifying glass, and you can either do a keyword or type the ticker. So if you see it like on Twitter or something, this is what I do. Type in the ticker, hit go. It's going to automatically default to like support articles, but you can click what you're looking for. If you click on symbols, there it is, and hit this little I with the circle, and that will give you a description of what the index is. We have a lot of breadth indexes, and if you do like this, I think this will work. You're going to see a whole list. Anything with !BI are basically a ton of different breadth indexes that we have, and you can just click on the little I in the circle, the information button, to learn more about what it is. So thanks for that question. That's what that particular index is doing. It's really sort of a non-signal at the moment. Question number 3, I've noticed that you and several of your colleagues rely on weekly charts for your long-term trend analysis. Is there an advantage to using weekly instead of monthly charts? That's a really good question. And to be honest with you, I think everyone sort of developed their own strategy. Monthly charts are really, really helpful because they put things into good long-term context. So I do use monthly charts. I don't show them as much on the show only because they don't change that often. That's by design, right? A monthly chart should be a real take a step back sort of moment. It reminds me of time spent in the Fidelity chart room where we'd have these huge wall-sized paper charts, a lot of times built on monthly data. And one of the benefits was just taking a couple steps back from the wall and looking at how this chart had evolved over time and looking at the real long-term trends. This is where you see things like secular bull and bear cycles, the business cycle, themes coming in and out of favor, sort of that long-term perspective that most of us probably need to work harder at having. So I do use monthly charts. I don't use them on the show as much. For me, weekly is sort of the go-to, and then I'll go to the daily chart from there. Thanks for that question. Last question, we only have a second. Nice quarantine beard. Thank you. I appreciate that. I'm working on it. It's something to do while we're all at home. RSI, what does that mean in terms of psychology? How do we interpret it? And you mentioned Connie Brown's comment on bull and bear ranges. So you'll note, I mean, one of the indicators I have on almost all of my charts is RSI. And you know, I take that back from lessons learned, you know, probably from the John Murphy book, the first book I ever read on technical analysis, which talked about RSI, and it immediately made sense to me. For me, it takes the price movements and standardizes them. It's sort of a Z-score for the prices if you're a statistician. I think that's a really good way of summarizing it. But you're describing more of the behavioral, the psychological aspect, and I think that's where Connie Brown's book, Technical Analysis for the Trading Professional, I want to say, talked about the range of the RSI. That for me was a pivotal moment as a technical analyst, understanding that. And so for me, Zoom as a great example of being in bear market range here in the second half of 2019. And you can see how it pivoted to be more in bull market range. And when it became overbought, that was the indication that it was actually a really good idea for the long side, because all of a sudden now it's more in it's bull and range. So, you know, another answer to an earlier question, the RSI remaining above 40 is a nice sort of long-term bullish read on a chart like this. So for me, I think the psychology is really important. I usually describe it less psychologically and more just as a descriptive indicator. I think the range of the RSI is a good way of describing price behavior and understanding whether investors are more in a bearish mindset or a bullish mindset when they're trading the stock. And I think for me, that's sort of the game, is to understand how people are wired for that sort of thing. Those were 4 fantastic questions, all coming from you in the last day or two. Thank you so much for sending them our way. And we need to wrap the show, folks, and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the AAII bull bear spread. And one of the things I mentioned earlier was just looking during our wrap the week segment about this huge change in the AAII ratings. We had a steady percent of bulls around 35 to 38% for the last 6 weeks. That has changed dramatically. We're at the lowest level that we've been since last September. So that's a big change. That's a change with a lot of people coming off of the bullish vote. Still 25%, still 1 in 4, but now it's a 2-to-1 ratio of people saying they're bearish versus bullish. If you look at the difference between those two, it's a 25% gap. That's the lowest it's been since that same time last October, last August. These were at sort of really negative parts of the market cycle. In some cases, as happened before, there's more downside. So I don't think it's telling you, we're at a bottoming point. It's interesting that there's this much of a rotation after we've had this much of a rally, suggesting individual investors starting to get tired of this whole rally thing. Chart number 2, I'm going to jump around just a second, but is healthcare, which is the XLV here. I wrote on my YouTube channel, Market Misbehavior, talking about the XLV and just, if there's one chart I was looking at to get a read on what was happening, I think the XLV might be it for a couple reasons. Number one, it's been an outperformer for the last over 2 months now, working during the downtrend, working during the uptrend. Overall, you've been paid to own healthcare. Number 2, it's approaching key resistance around 104, 105, which I think is really important. But number 3, this is the performance of healthcare versus technology. Healthcare has been the better bet over the last 2 months. Finally, is biotechnology. I'm looking at the BTK and I'm seeing an index that is right at previous highs. And if biotech is able to eclipse that, push higher, I think we have to start thinking less bear market rally and more bull market, right? Overall. Ladies and gentlemen, that's our show, and that's a week. For the final bar, I want to thank you so much for joining us. Please keep sending your questions, your feedback to us, thefinalbar@stockcharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.